How do businesses calculate the amount of profit or loss made during a period? I'm Thomas Harwood and welcome to The Accounting Student, where we create free and short videos so that you can learn about accounting. Today's video is looking at the second part of the income statement, which is the profit and loss account. Most companies are started with the purpose to make a profit, and in many cases they do. However, unfortunately some make a loss. The computation of profits and losses is questionably the most vital objective of the accounting role within a business. This is why we have the income statement. In our prior video on part 1 of the income statement, we found out that the income statement, which is also known as the trading profit and loss account, is a summary of the revenue and expenses of a business, and as a result this can establish the level of profit or loss made in a given period. The income statement is helpful to identify what profits or losses were made by the business during a period, and can help the business and its stakeholders carry out many tasks, including planning ahead the future period's activities and trading, looking at whether the business is capable of acquiring loans from banks and other financial institutions, providing information on the business performance to potential business partners and those who might invest in the future, and being able to calculate the tax to be paid on the trading profits. The income statement can be broken down simply into two main sections, and they are the trading account and the profit and loss accounts. In this video we will look at the second part, which is the profit and loss account section. If you missed the first part of the income statement where we looked at the trading account section, the link is in the description below. The profit and loss account section computes the net profit of the business for the period. The net profit is described simply as the amount left of the gross profit after all other expenses have been deducted. The profit and loss account section of the income statement deducts all the expenses related to running the business away from the gross profit, which was calculated in the trading account section. It is important that these costs do not include the costs relating to the costs of goods sold, as these have already been included in the trading account section and subtracted to get to the gross profit, and then any one-off revenues are added to this sum to give the net profit. Now let's have a look at how this will be laid out. First, we have the gross profit amount from the trading account section. We then add all the other incomes and revenues to the gross profit value. This could be anything ranging from the rent received by the business's tenants to the discounts received from the business's suppliers. Then we take away all the other expenses used in the period other than the ones that have already been included in the cost of goods sold. In this example, the other expenses include rent, insurance, light and heat expenses, and bad debts. As a result, this gives us a net profit. However, where the costs used up exceed the gross profit plus the other revenue, this results in the business having a net loss. The net profit is an important measure of the business's performance and to see how efficient they are at managing their operating costs. So that was the second part of explaining the income statement, its purpose, and the profit and loss account section. If you enjoyed it, press the like button. If you have a question you want answered, leave it in the comments below and we'll try our best to answer it. And if you're not already subscribed, make sure you click the red subscribe button to keep updated with The Accounting Student. Thanks for watching. We'll see you next time.